reporting season is during the month of August, and the month of August was extremely volatile. The market, the ASX 300, was down 7.7% over the month, really on the back of concerns around growth in the Chinese economy, the surprise devaluation of their currency, and also the gyrations of the Chinese economy. In terms of the earnings backdrop over the reporting season, came in weaker than the market expectations, and more importantly, the outlook for 16 is actually weaker than what the market was expecting as well. So from that point of view, the major themes were came in below expectations, weaker outlook for 16. One of the other highlights is we saw an increase in dividend payout ratios. Most notably, companies such as Horizon increased their dividend payout ratio. But on the whole, what we're seeing is companies finding revenue growth very difficult to come by. A lot of the cost out opportunity over the last couple of years is not there, and that's really translating into lower earnings growth outlook for this year coming. I think the standout results for reporting season, Medibank was a standout result. There were very low expectations going into the result. Revenue growth was a little bit weaker than expected, however, more than offset by improved operating margins and also management expense cost control. BlueScope was another very, very strong result, one that we hold within our portfolios at Perpetual. The international businesses delivered very, very strong results. The Australian business, there was good cost management, and that took the market by surprise. So they delivered above expectations, and that was a very strong performer over the month of August. Also, another one that we hold at Perpetual, Sims Metal, delivered a very, very strong result, especially out of their North American business. So the strategic review and cost out program that they are enacting on is actually working, and the fruits were seen in the underlying result with a very, very strong cash balance at balance date. Oh, there were a number of weak results. Ones that disappointed. I think SEEK disappointed the market. Not only did it miss its fiscal 15 numbers, but also the outlook was quite weak versus what the market was expecting, really due to lower yields on their domestic business, online business here in Australia. And the muted outlook was more around increased reinvestment in the underlying business and a weaker outlook for SEEK Learning. So that disappointed the market. Moving on, the banks I think were quite mixed. I think what the major surprise in the banks came from ANZ, in particular increasing their collective provisions around their agricultural and also resources loan book. That took the market by surprise. On balance, when you have a look across the banks, margins were flat to down, slightly offset by better funding costs, but also the outlook is muted for the banks, really taking into account the capital that they've had to raise due to APRA's increase in risk weights. That's also diluted earnings growth moving forward for the banks. In terms of CSL, that's another one that disappointed. Came in line with downgraded guidance for fiscal 15, but the outlook was a lot weaker than the market expected, again due to increasing reinvestment in the underlying business and also increasing competition globally. Well, look, the market, as we mentioned prior, the market has had a significant pullback over the last month. We've also seen earnings growth outlook being pared back a bit as well. So when you put that all in the mix, the market is trading very close to its long-term 1 year forward multiple of 14.5 times. And given where interest rates are and the dividend yield of the market, we think it's a reasonable value as it stands today. Obviously, we're always monitoring how the economy is changing and how that impacts earnings, and that also goes into our thinking. But as it stands today, it's reasonable value. Well, where we're finding value at Perpetual at the moment and what we've been buying since reporting season is a stock like IAG. It's been sold off aggressively since the result. It was a good result that met expectations. The outlook was maybe a little bit softer than the market expected, but we think the real reason it's been sold off is around its strategy to go and invest in China, and it's been marked down to a level where we see value at around $5. It's around trading at around 12.5 times forward earnings with a 6% fully franked yield, and we see that as value for the next 2 to 3 years. So that's a business that we like and we have been buying. Also, Woolworths, a business that's in a little bit of turmoil. a great business. Their food and liquor business and their supermarkets business in Australia is the market leader. What we're finding is that we've had a lot of change at the management level and also at the board level. They haven't been hitting their sales numbers. The stock has been marked down aggressively, where now it's starting to trade at an undemanding multiple versus its closest competitor, which is Wesfarmers or Coles. And so we see that as an opportunity, and we have been slowly accumulating that stock as well.